The stock market crash that occurred on October 29, 1929, pushed the economy into a downward spiral that would become known as the Great Depression, which characterized the 1930s. This video will explain how the stock market works and how the stock market crashed. Here are some key terms that you want to write down, and the objectives. These are things that you should be able to do after the video is over. Okay, so what are stocks? Stocks represent ownership of a company and a claim to assets and earnings. So when you purchase stock, you're investing your money into a company in the hopes that if the company does well, the value of your stock will increase and you'll make money. While purchasing stock represents ownership, one doesn't have decision-making power unless they own a large percentage of the company's stock. The stock market is where stock is purchased and sold, and where the values of stocks are reported throughout the day. The stock market today is regulated by the SEC, which is the Security and Exchange Commission, and the Federal Reserve Board. But back in the early 1900s, the stock market went virtually unregulated. Only a small group of board members who were not affiliated with the government regulated the market. Investing in the stock market is risky, but the rewards can be great. Think about someone who invested in Apple in the 1980s, before the iPod, the iPad, and the popularity of Apple products. Stock values of Apple when they were first offered to the public in December of 1980 were only $2.75 a share. Recently, Apple stocks have been in the $500 range. If you'd purchased 20 shares of Apple stock in 1980 at $2.75 a share and you never sold it, you would have invested $55 and today would hold stock that is valued at approximately $10,000. On the other hand, what would happen if you invested in a company that went bankrupt? Imagine investing in a company where your stocks were valued at $10,000 but then plummeted to only $55,000. The stock market is volatile and risky, and the value of stock depends on several key factors. One factor that determines the value of stock is how well the company does. If a company reports a profit, especially one that is higher than predicted, stock values can increase. Another factor is how popular the stock is. If a lot of people want a stock, then the value can increase. If it's not that popular and demand is low, the value can drop, just like the price of a product in a store that people don't really want. If a lot of people are selling a stock, the price can drop as well. Human emotion plays a role in the value of stock, not just the economy itself. If a stock takes a temporary dip and people begin to panic and sell prematurely, they can actually drive the price down even more. People can get greedy too and hold off on selling even after a gain because they think the stock could gain even more, when in fact it actually dips in price. In 1929, human emotion was a major factor in causing the stock market to crash. A stock market crash is a sudden, dramatic drop in stock prices. Oftentimes, a crash follows a bubble or a period when stock prices are unusually high. On October 24th, stock prices began to fall slowly. Companies that produce cars and radios, which had already been purchased by many, were experiencing a slowdown in production. This caused the value of their stock to dip a bit. As people saw the prices drop, they panicked and sold their stock quickly in the hopes that they could cut their losses. The Board of Regulators temporarily closed the stock market, but it wasn't enough to stop the panic. When markets reopened on Tuesday, worried investors continued to sell their stock. A total of $30 billion of stock value was lost that day. This sudden and dramatic loss of stock caused the stock market to crash. In addition to the crash, the stock market also contributed to the depression in another way. The get-rich-quick attitude of many led them to over-speculate in the stock market, meaning that they made very risky investments. Some even had their entire life savings in the market. The feeling of limitlessness and optimism during the decade was symbolized by the overconfidence that many Americans had in the stock market. In only 4 years, the overall value of the market had increased by $60 billion by 1929. Now, to make matters worse, some people purchased stock on margin. Buying on margin, as it's known, means that you can buy stock without having to pay the full value. You can pay just a fraction of the cost of a stock and pay the rest back later. So it's basically like buying stock on credit. As people purchase stock on margin, they hope that the stock's value would increase enough to make them a profit and provide enough to pay back what they had borrowed to buy the stock in the first place. Even worse, banks were also invested in the stock market and they quickly ran out of cash not too long after the crash in October. So when the stock market crashed, not only did people lose the money that they'd invested, but they now owed the stockbroker and the bank money that they simply didn't have. The Great Depression was sparked by the crash, but other factors contributed to a widespread economic crisis. The next video will go into detail about the causes and effects of the Great Depression. Don't forget to answer the Think questions and write down any questions that you have to go over in class. Have a good night.